Chris Miles here, anti-financial advisor with Money Ripples. Here's the question that people ask all the time, and it's online. It's even, they ask it of me, is which is better, Chris? Is it the Index Universal Life or IUL? Or is it the whole life, especially if we do it the infinite banking way? So I'm going to talk about both. So here it goes. This is the big contender, the big fight, the matchup we've all been waiting for. Ding. So poof, here we go. All right. Now, just so you know, whole life, if you do the normal whole life, we're not talking about that because the normal whole life doesn't beat anything, including what we talk about here with whole life. We're talking about how do we have the best cash rich policies. And we're also adding an element of what about having the death benefit too, because that is important to many, many people. And that's the ultimate purpose of life insurance. Although the purpose that we're focused on here is how do you get the most tax-free cash value savings building up in these policies? Now, there's a few things that people say that IULs are better. They'll say that IULs are cheaper. They will say that IULs have a lower premium. They'll say they have a better death benefit. They'll say things such as really that it's more flexible. You have better ability to be flexible in the premiums and not be forced into that. And that's all true if you're comparing this to normal whole life, but that's not what we're doing here. So I want to give you an example of two situations of clients that I've had where we've been looking at this very comparison, right? One of these clients is younger, only putting in a smaller amount, while one of these is older, putting in a large amount. All right, so this first one right here, this is the one that he was introduced as an IUL. Now notice he's putting in $3,900 a year. He's 27 years old. That first year, $2,780. Not bad actually for an IUL. This is actually not too shabby. But here's the thing you got to be careful of. That surrender value right there is zero. Goose egg, right? Big old fat goose egg. That's the money you actually have access to. So even though the accumulated value is there, they have these surrender charges that make it zero. Even the next year, you have $5,700 supposedly, but you can only access about $550 of that. Now, notice this in the policy that I would do, apples to apples with him. Look, $3,900, he's got $2,800 in the first year. Remember, the other one was about $2,700. This one's got about $100 more. Furthermore, the next year, you'll notice here we got about $6,000, not $500, right? So already there's access to cash from day one, much, much different. And that's what a lot of people that try to sell you IULs will say, oh, you don't have any cash in those whole life policies. That's true if you use traditional crappy whole life. Now, as it keeps going on and on, you'll see here, even 25 years down the road, right? He's got a whopping $103,000 right there, a death benefit of $428,000. Now, here's one of the things that people say too. They say, Chris, whole life is horrible because you lose your death benefit or you lose your cash value when you die. So the nice thing about this IUL, the way this is designed, is that it's that $325,000 plus the cash value, which gives you that death benefit of $428,000. So you get the death benefit and the cash value. Now, I'm not being a proponent of Index Universal Life or an IUL here because watch this. On my very example, 25 years down the road, look, we got $177,000 compared to the $103,000 that the IUL has. So we're kicking the crap out of it by like 75 grand almost. And look at this. It's got a death benefit of $486,000, almost $500,000. So the crazy thing is that this one actually started with less death benefit. And I even, to bridge the gap, if they wanted more death benefit, we can get a cheap term for a couple $100 a year. So with a whole life example, you don't just get the cash value and the death benefit, you actually get a bigger death benefit than what you actually had in the beginning. So it actually goes up more and faster over time. So the truth is on this one, even put in $3,900 a year or $325 a month, our policy kicks the crap out of IUL. So winner, ding, goes the whole life, right? IUL doesn't compare. Now, I did say this to this same guy. I said, if these were bigger numbers, you get better returns because the policy does better if you put in more numbers here. So I'm going to show you one that's putting in $50,000 a year. So this guy was sold. It was actually presented in IUL for putting in $50,000 a year. Now, year one, you'll see the cash value. Now, this is the non-guaranteed up here, the current illustrated for them. Here's the thing with Index Universal Life you got to understand. Index Universal Life is set to the stock market, right? It's all based on, and there's a cap, there's a ceiling, and then there's a floor. So some of these floors might be 0 to 1% or so. while the ceiling could be 9, 10, could be higher percent, but they can change these floors and ceilings whenever they feel like. So it's really hard to guess. And just so you know, I used to be a huge IUL fan back in the day. 15 plus years ago, I was selling these IULs, trash talking whole life until I realized that you can do things a lot differently and there's better guarantees on the whole life side. So, anyways, this one again designed pretty decently. You can see here you put in 50,000. He's got 41,000 in year one, right? Not bad. In fact, he even beats mine. Mine has 39,000 in year one. So guess what? Year one, ding, goes to IUL, right? Now year two, I have 82,000. They have 85,000. Year three, now here's where it happens. Year three, you see about $131,000 in this IUL policy. Mine in year three, 134. So now it's not just caught up, but surpassed it all of a sudden. Because here's the difference. IULs have a term chassis, right? It has term insurance that renews every year, getting more and more expensive. So the cost inside this IUL policy is actually getting more expensive every year while it's trying to earn dividends, trying to earn interest rates based on the market. But with the whole life policy, it starts with heavier up front and less later on, which is why it starts surpassing it at year three. Heck, you'll even see, and it's already paying for itself. You're actually making more than what you're putting in. Year four, 190,000. Year four on this one, 178,000. Now there's a $12,000 difference versus three. Now look, year 10, 531,000 in this one. In mine, it's got 525,000 in here, right? Now, you might say, wait, Chris, you have less. But we also put in less. Notice I actually told them, hey, we can back it off and start doing the minimum premium thereafter. So we actually started putting in just 13,000, about $600 a year. So we're putting in now about $37,000 less for 2 years in a row. So we put in 74,000 less. And look, he finally caught up. He finally caught up at that point. But the ROI is still less than what we're getting with the whole life. And just so you know, the whole life, the interest rate it's showing is the lowest it's been in decades. As interest rates have been rising, this actually gives more pressure for whole life to pay more versus the other way around. Here's the other thing. IULs are based on the stock market. We've had 13 up years in a row through 2021. 2022 now has been down. What happens? Well, you end up making the floor rate. You might make 0 or 0.75 or 1% or something like that. The problem is that now the cost could actually exceed the returns you make on that policy, and you could start losing money in an IUL. Where with whole life, even if you get the guaranteed like 3 or 4%, you still at least make money. It's guaranteed you will always grow your cash value regardless. Okay. So yes, he surpassed it, but that's only because he put in more, 74,000 more to finally beat it by a few thousand. The crazy thing is this. Now he stopped paying in at this point. He put in 500,000 total in 10 years. I put in 480,000 after 14 years. So let's look at year 14 when they finally get similar. Year 14, he's got 650,000 in his. Mine, we've got 705,000. So we beat it again just because we kept putting in a few more years. We just did less, right? We just did less spread out over more time. Year 20, they have 876,000. You see that in yellow? Year 20 on this, we've got 960,000. Next year, it hits over $1 million. Again, based on lower conservative returns and numbers in the whole life versus the IUL, which really there are no guarantees. We don't know what it's going to do because we can't predict the stock market. We can't see what it's going to do. And we cannot predict what the insurance company will do based on where they put the ceilings and the floors. Because what if all of a sudden the stock market turns around and the stock market shoots up, but they lower the cap rate down to 8%? So if the stock market makes 20, 30% in a year, you make 8, maybe 10. Well, that's great. But then all of a sudden, when those down years come, you're making 0 or 1, maybe. It's hard to figure out. Oh, here's the other thing too. Remember the death benefit. I mentioned that. They say the death benefit's worse. Well, guess what? The death benefit on this is 1.459 million on the IUL. On this one, 1.675. So we got 200,000 more death benefit. We've got about 100,000 more in cash value. And overall, here's the thing is that even the required premiums, I stopped the premiums at this point, and he did too, which is great. The problem though, look at this, the IUL. Here's the risk that you have that most people won't show you. is if you go down here, and again, this is a really decently structured IUL. This is not horrible. But look, if you only earn 3% average, right, it ends up lapsing when he's 89. I've seen others that they lapse in their 60s, 50s, maybe in their 70s or so, even if they earn the same return. I had another example. I didn't want to show it here, but they had another example where it actually would lapse even by the time he was 81, earning the higher illustrated return. So either way, they would have to put in more money or run out of money. Actually, that's happened right here. In fact, in this one, this is the non-guaranteed, but you'll see here, look, as you go down, age 90 right here goes to 0, and then it lapses at age 91. So even though it grew, look, and this is what happens with most IULs or UL policies in general. Any universal life, this tends to happen. As it goes up, it starts topping out, right? It looks like it slows down. Like at first it looks great. You're like, oh, okay, it's growing by 6,000 a year. Ooh, slowing down to 2,000 a year. Oh, now it hits a pinnacle right around 195, 196, and then it starts heading downward, which means he would have to put in more than 3,900 a year to make sure he gets it. Where on the other policy I sent him, even at this rate, and I even had him stop paying, in his mid 60s, this thing is still going to keep going up. Guaranteed. It has to. That's the way whole lives are designed to be, is to be guaranteed. But here's the real question, right? Overall, yes, we have more cash value both ways. We have more cash value in the whole life than we do in the index universal life. But what's really important is how do we make it work? It's not just leaving the money in here. It's then using this money to then invest in other places where you can make returns. Because the number one objection against both of these kind of policies, if they're saying, well, why pay all these fees in the first place? Why would I even want to pay for this? Besides the fact you have a death benefit, why would I want to pay these fees? Because, especially with whole life, which you cannot do as well with universal life, whole life, I can get a bank line of credit for sometimes at least 2% less than what they're paying me on my life insurance. So say I'm earning 5% of my life insurance on my whole life policy, but then I get a bank line of credit at 3%. 5 minus 3 is 2%. I make a 2% return on that money. And then I invest it in real estate or whatever investment I want to do. And say that real estate pays me 10%. Well, 10 plus the 2% I made from the bank because of that spread is 12%. I'm no longer just making 10% on that real estate. I'm now making 12% plus because it compounds. That's the huge thing, right? That deserves an applause right there, right? There we go. That was your applause. So anyways, that's the cool thing, is that you can actually double dip on your investment returns when it's done right. But you got to get the lowest fees possible of those whole life policies to make them not only beat the IUL, which would be the easy winner, but also you get to beat anybody just doing normal investing, because now you make money in two places. And most people don't do that. Most people make money, take their money out of cash savings or their checking, throw it in their investments, and that's where they make their money. Even if they make good money with that, what if you can make a few percent more than what's already good? That's exactly what we're teaching you guys to do. So there's plenty of other videos. I say check out other recommended videos on life insurance and how that really works. But here's the thing, guys, is that IUL can beat whole life if the stock market keeps going up. But after 13 years of going up, do you really want to count on that going up anymore for the next few years? That's going to be a big risk, and that could kill all your numbers and make it even worse than what I just showed you here today. So guys, this is the thing, is that it's all about you. It's about how you come out on top. If you want to find out how to do that, reach out to us at moneyripples.com. Make it a wonderful day.